Hello, and welcome to Live from the Compound, America's favorite ongoing video series about investing. I'm Josh Brown.
What is that? What is that intro?
I'm doing a new shtick. Listen, Michael did this amazing post about uncomplicated investing. He shows you how you can build a 2-fund or 2 ETF portfolio and get pretty much everything that's coming to you as an investor. Stick around. What?
Oh,
let's get into the conversation.
I jumped the gun.
Okay, music.
Sorry, I was so excited.
All right. So, talk to me about what the idea was behind putting up the post uncomplicated investing, because you have a little bit of a preamble in here.
Yeah, I mean, pretty much everything that I write about is why investing is so hard.
Right.
I mean, I wrote a book on why investing is so hard, and I just made the point.
Why do you have to make everyone miserable?
Yeah,
always?
so I was like, man, I'm such a negative Nancy.
Right.
So I just wanted to show the other side about how simple implementing or constructing a portfolio can be, and it could be even simpler than I suggested. You could just do a target date fund.
Right.
And call it a day, just one product.
So what you're basically doing? Walk us through what you're doing here, because we're gonna put this drawdown chart up.
Okay, so I was talking to the average Joe who really doesn't care about the market, wants to invest but doesn't want to watch CNBC or pay attention to the news or anything like that. So what they should do is they should think about worst case scenario, because it is likely that they are, I mean, of course you can get distracted in a bull market and do something dumb and chase whatever, but the majority of like irreversible damage is probably done in a really bad market.
I agree with that.
You had a great line a few years ago. A correction is when you notice, or when you open your account. A bear market is when your wife opens your account or something like that.
Yeah, something like that.
So
then I got ratioed because it was like deemed as sexist. I didn't mean it that way. It could have been directed toward anyone. I could have said, I think I said a correction is when you notice that your account is down, and a crash is when your wife does. But that could have been just as easily been husband.
All right. So anyhow, so the point is that you're more likely to do irreversible damage in a bear market. So with that premise, you should work backwards. What is the maximum dollar loss, not percentage? What is the maximum dollar loss that you can stomach realistically?
Okay, so the average, like a typical investor, let's say they managed to save $100,000.
Yep.
They have that invested. Is the number 20 before they lose their mind? Is it 10? Is it 30?
How many dollars can you say?
But do you think that people can figure that out in advance? Or they have to in order for this to work?
Given what I put on paper, I think you can.
Okay.
I mean, can they on their own?
Yeah.
I mean, no, they can't.
They can't.
With the help of somebody.
Or the answer will change as they're actually
Yeah, so the point that I made was, if you can't stomach the idea of losing 30% of your money or $30,000 on 100,
right,
then in real life you definitely can't stomach that.
Right. So now, all right. So we have this drawdown chart where you're showing different ratios of stocks to bonds, and I think you're using MSCI All Country World Index, which is global stocks,
and U.S. bonds,
and you go from 100% stocks to 100% bonds, and this is awesome. You're showing like each color is a different mix, and how bad things have gotten historically for this portfolio.
Yeah, so if you say, okay, I have $100,000, I could have lost $55,000, that's too much.
Yeah.
You take it down, $40,000, that's still too much. I'm not comfortable there. And at least that gives you like something to work with, as opposed to like, oh, I'm aggressive because the market goes up.
So we kind of use Riskalyze. It's a different chart and it looks different, but we kind of like, before we speak with an investor, one of the first preliminary things we'll do is have them go through a Riskalyze questionnaire, which quantifies like a portfolio that, drops 20% but has the ability to make you 40%.
Yeah.
Like we put them through some of those tests.
But the real test is, tell me what you did in 2008.
Right.
Right? Like, because their risk, as you know.
And then talking in percentages to people about risk tolerance is ridiculous.
It sort of hides the reality. But
you need to hear it in dollars.
But their risk score can change from month to month.
Day to day.
If they were left to their own.
Right. Okay. So now let's say I say to myself, okay, in 2008, 2009, that period, had I been down 25%, I could have lived with that. So you're basically showing, guess what? That's a balanced portfolio. That's 50-50. Global stocks and U.S. bonds. And look, that's not going to be a great portfolio as far as long-term gains, but you can live with that.
It's fine.
As a worst case,
So if you beat a 60-40 portfolio every single year by 1%,
right,
the 60-40 portfolio captured almost 70% of those gains.
Okay.
So nobody actually can beat it by 1% every year. But even if you could,
So even if you put in all this effort and the net result was you were 1% ahead a year,
every year.
it like didn't add up to that much dollar-wise.
$1. I mean, $1 grew to $87 if you beat it by 1% every year versus $1 growing to $58.
So what's the message behind that stat?
The message is that you don't have to scrape and claw for alpha that you're probably not going to get anyway.
Right. So basically, if you can own global stocks, you can own the aggregate U.S. bond market. You can own them without paying a lot, and you kind of base that mix, that ratio, not just on how old you are, which is how people used to do it, but like based on what that dollar loss would actually equate to.
And so this in a vacuum will get you pretty much where you need to be.
Right.
Now, good luck implementing this. What, are you really going to buy 2 funds and just forget about it?
No one's going to do that.
No one's going to do that.
Yeah.
You can.
You can, but it won't happen. Or they'll do it and then they'll change things up.
They get bored.
They get bored, or they'll feel like it's not enough.
Yeah.
Somebody will say, "That's it. That's all you're doing," and
Like
then
portfolio shame somebody.
somebody will get portfolio shamed. All right, what do you guys think about the two fund portfolio? We'll post a link in the show notes below. Let us know your thoughts. Please share your feedback. We love your feedback. We love your likes. We love your comments, and we'll come back to you soon.